Speculation about whether the Fed will cut interest rates can generate a lot of headlines, but it's not always clear how a rate cut might affect investors. So let's discuss how lowered interest rates can stimulate the economy and impact financial markets. Also, let's take a look at which types of investments have historically performed the best in low interest rate environments. The goal of the Federal Reserve, or the Fed, is to keep the US economy healthy in two ways: minimizing unemployment and stabilizing inflation. The Fed does this by decreasing or increasing interest rates. Historically, as the economy has shown signs of weakness, the Fed has responded by cutting interest rates. Here's how it works. A committee within the Fed, called the Federal Open Market Committee, meets 8 times a year to look at the health of the economy. If there are signs of a weak economy, like rising unemployment and stagnating job growth, the Fed may decide to lower interest rates, specifically the federal funds rate. Generally, when the federal funds rate is low, banks lower their interest rates. This can help stimulate economic growth in a couple ways. First, lower interest rates make it cheaper for people and businesses to borrow money for big purchases or new ventures. Second, cutting interest rates makes it less profitable to keep money in bank accounts. Instead of saving, individuals and businesses may want to invest or spend that money. The goal is to kickstart a virtuous cycle of spending and growth that creates jobs and steers inflation to more healthy levels. However, it'll likely be some time after the Fed cuts rates before consumers begin to feel this type of economic growth. Though the economy responds slowly, you may see changes in the stock and bond markets immediately. For major stock indices, rate cuts are typically good news. While expectations are often priced in, sometimes there's a surprise that can cause the market to spike. In fact, sometimes just rumors of cuts can cause a rally. For example, in June 2019, Fed Chairman Jay Powell assured that the Fed would act as appropriate to sustain the expansion. Many investors interpreted this as a hint that interest rates could be cut. As a result, stocks soared and the Dow broke its 6-week losing streak. Historically, the S&P 500 index has generally performed well following interest rate cuts. This may be partially due to economic recovery, but could also be due to investors' increased optimism. Interest rate cuts can also have a major impact on the bond market. This is because if interest rates are going to be lower, older bonds with higher interest rates become more valuable. For investors who already own bonds, interest rate cuts can potentially allow them to sell their bonds for a higher price on the secondary market. Over the past 46 years, the performance of stocks, commodities, REITs, and gold was relatively balanced. But during low interest rate environments, REITs and US stocks have been the highest overall performing asset classes. Because interest rates are typically cut during economic slowdowns, defensive stock sectors may be better poised to weather low interest rate environments. Think of it this way. Reduced rates in bonds may cause investors to look for income streams elsewhere. This can cause increased demand for stocks that are known for their steady dividends, like real estate, utilities, and telecom. Consumer staples may also be a good investment during a rough economy, because people will always need food. Plus, these stocks tend to pay dividends as well. But remember, the point of cutting interest rates is to nudge the economy in the opposite direction. Though cuts may be the result of negative economic outlook, forward-thinking investors may want to anticipate how interest rate cuts may help spur long-term economic growth.